Welcome back, everyone. With the stock market up more than 100% from those scary days in early 2009 and up 16% last year, the big question is now the time for the average person, the small investor, to get back into the market?
Christopher Markowski is CEO of Markowski Investments, and he's the host of the nationally syndicated radio show, The Watchdog on Wall Street. Welcome back, Chris.
It's a pleasure. The world didn't end a few years ago.
I got to tell you something. We all thought it would. And a lot of us...
You built a bunker in your backyard, your seed banks, gold, all that stuff.
But a lot of us, who have maybe just a little bit in the stock market, I'm still afraid to invest in the stock market, even though it's been going up and up and up and up, because you keep thinking it's going to bust again.
Well, two rules. Okay, I'm nervous now, too. Whenever you see something go up, you should be nervous. Unfortunately, what happens is people freak out when they see things go down, and they miss out on one of the best buying opportunities we'll probably ever see a few years ago.
Right.
With that being said, you stick your money into a bank account, you're losing money. With inflation, and everybody goes to the grocery store and they see how expensive everything is getting, and the banks are not giving you any rate of return at this point in time. You have to be consistent over time. Bumps in the roads are going to happen. Like I said, never bet on the end of the world, but try to pay yourself every month what you can afford. Don't be one of these psychotic people out there that says, okay, I'm not going to have Starbucks anymore, even though you like Starbucks. Just put a little bit of money away every single month. Pay yourself.
Not every stock is a winner, and I think a lot of people are afraid to take a chance because they think, oh, I'm going to put my money in, I'm going to lose it all. So what do you tell people who are afraid to even get their toe in that water?
Well, if you're starting out, first and foremost, going and looking for individual stocks is a little bit difficult. It was interesting this past week, Dell Computer, which used to be a high flyer, is being taken private. Wow. I mean, if you think back 10, 12 years ago, Apple Computer was dead. Apple Computer? Who wants to do anything?
Yeah, no kidding.
But that's part of the idea. You want to be diversified into various different assets, and you want to do it over time. The key is compounding interest over time. Well, look for companies that pay you to own them.
Let's talk about that diversification. Okay. So if you're looking at your family's budget as a piece of pie, how much of it should be in the stock market?
That all depends. I mean, everybody's situation is unique and different. I try to design people's portfolios based upon their goals and wants and their positions in life.
And their level of risk.
Absolutely, yeah, and everybody's different. Obviously, as you're getting older, your level of risk starts to decrease. But also as well, it's a big myth out there saying, oh, I'm young, I've got 20, 30, 40 years to invest. You know what, I can get real aggressive. And I say to myself, why? If you just see 6, 7% a year, you're going to be rich. Yeah. It's not a matter of if, it's just a matter of time taking its course.
It's a matter of patience,
yes,
right?
Exactly.
Should we do the Warren Buffett and buy the companies that we support? That he goes to McDonald's every day, and apparently he has quite a bit of stock.
Well, I think that's definitely a way to go. But if you're starting out, one of the things I would do is try not to go looking for individual stocks right away. You want to kind of build up to that. Start with some various different funds that you can build up to. And then once your portfolio, and it will grow over time, once it gets to that point, you start doing some individual stocks is a little bit better.
All right, somebody who has never, ever, ever dabbled in the stock market, who wants to get in now, smart move?
Always smart to pay yourself and to put money away. The key is, once again, is diversification and compounding. The bulk of stock market returns throughout history haven't been because of buy, sell, hold nonsense that you're watching on TV. It's by compounding small gains over time. If you could just see 3, 4%, compound it over time, you're going to get
better than the 1% in the bank account.
Absolutely, that's for darn sure.
Don't panic if it goes like that.
Yeah, exactly.
Christopher Markowski, thank you.
It's a pleasure. Thanks for having me,
Chris. And we'll be right back with more Daytime after this.